Hello, and welcome to Black Spot. Let's talk about gold. For literally thousands of years, it's been the ultimate symbol of wealth and stability. But lately, its price has been absolutely skyrocketing. And that's got everyone, from investors to top economists, asking a really critical question. Is this a rational response to a chaotic world? Or is it a warning sign that our entire financial system is on seriously shaky ground? Well, in this explainer, we're going to dig in and find out.
Just look at this number. Some analysts are projecting that gold could hit nearly $4,900 an ounce by 2026. Now, that is a staggering figure. And you've got to understand, that's not just a number on a chart. It's really a reflection of our deepest anxieties about inflation, about geopolitical conflict, and, about the stability of the entire global economy.
So that brings us to the core question of our entire analysis today. Is a price this high actually rational from an economic standpoint? Or is it a symptom of something much, much deeper? To answer that, we really need to strip away the myths, ignore the hype, and just look at the hard data.
Okay, so here's our game plan. We'll start with gold's long and storied history, then we'll try to untangle the really complex macroeconomic drivers. After that, we'll look at its role in geopolitics, zoom in on India's unique gold market, and then critically examine its reputation as a hedge. And finally, we'll ask what this all means for the future.
All right, so first things first, let's get some context. To really understand gold's role today, you have to appreciate its incredible journey through thousands of years of economic history. You see, it wasn't always just an asset in a portfolio. For centuries, it was money itself.
For most of human history, gold wasn't just valuable, it was the definition of money. Its scarcity, its durability, it was the perfect anchor for currencies under what we called the gold standard. But then, the 20th century came along and changed absolutely everything. By 1971, the US officially cut the dollar's last tie to gold, and just like that, we entered the modern era of fiat currency, money that's backed only by trust in the government that issues it.
So the moment it was unpegged from the dollar, gold completely transformed. It was no longer the anchor of the whole monetary system. Instead, it became a globally traded asset. Today, it's held by everyone, from individual investors trying to save for retirement to the world's most powerful central banks. And they all see it as a way to preserve wealth in these really uncertain times.
And this brings us right to the big macroeconomic puzzle. Probably the most common argument you'll hear for owning gold is that it's a fantastic hedge against inflation. But is that actually true? Let's see what the research says.
Okay, this is the key distinction we need to wrap our heads around. Is gold protecting your purchasing power or just your nominal wealth? Think of it this way. If a loaf of bread costs $5 today and your gold is worth $100, you can buy 20 loaves. Simple. Now, if inflation doubles the price of bread to $10, a true hedge means your gold should now be worth $200 so you can still buy those 20 loaves. Your actual position hasn't changed. That's the goal.
And, just so we're all on the same page, this is the official academic definition of an inflation hedge. It's supposed to be an asset that shields you from the corrosive effect of rising prices. So, the billion-dollar question is, does gold actually do this job over the long term? Well, this is where everything you might have heard about gold gets turned on its head. A major study looked at the 5 biggest gold markets on the entire planet, and the conclusion was, well, pretty unambiguous. Despite what you might hear on TV, in the long run, gold is not an effective hedge against inflation. Not in the UK, not in the US, not in Japan, China, or India. The data just doesn't support the claim. So if it's not just inflation driving the price, what else is going on? Well, in a word, the Fed, the US Federal Reserve. This shows just how extremely sensitive gold is to monetary policy. Back in 1980, when the Fed hiked interest rates like crazy, bam, gold suffered a massive daily loss. Fast forward to 2013, when the Fed just hinted at slowing down its bond purchases, gold crashed again. Its price is deeply, deeply tied to interest rates and the value of the US dollar. And that leads us right into the geopolitical story. Because if gold's price isn't just about inflation, it's clear that its value goes through the roof during times of global crisis. But to really understand why, we need to be super precise about the words we're using.
You hear these two terms thrown around all the time, but they're absolutely not the same thing. A hedge is for predictable, slow-moving risks, like inflation. A safe haven, on the other hand, is what you run to during a sudden, shocking crisis, a market crash, a war, a pandemic. The data strongly suggests gold functions much more like a safe haven than a hedge.
And you can see this playing out in the behavior of central banks. In this new era of geopolitical tension, with all these questions about the long-term dominance of the US dollar,
Central banks in emerging markets have been buying gold at a truly historic pace. It's a strategic move, a way to diversify their reserves and protect themselves from financial and political shocks.
The 2008 financial crisis gives us the perfect case study. This is gold acting as a safe haven in real time. The day after Lehman Brothers collapsed, the fear of a total systemic failure was palpable, and investors just piled into gold, pushing its price up over 10% almost overnight.
But, and this is a huge but, just 1 month later, the script completely flipped. As the crisis got even deeper, investors were suddenly so desperate for actual cash to cover their other losses that they were forced to sell everything they owned, including their gold. This dash for cash caused a sharp 7% drop. It just goes to show you gold's dual and sometimes contradictory role in a crisis.
Okay, now let's zoom in on a really specific and, frankly, fascinating case: India. It's one of the world's largest and most culturally significant gold markets, and it has its own completely unique dynamics.
You see, in India, gold is so much more than just jewelry or an investment. It's a critical financial tool. Millions and millions of people use their family's gold as collateral to get loans. And this process, which economists call financialization, it basically turns a cultural object into a financial asset. What that means is that a sudden drop in the global gold price caused by market jitters in New York could directly impact a family's ability to pay its bills in Mumbai.
And this raises a really serious question about systemic risk. What happens if there's a sudden, sharp drop in the global gold price? Could it trigger widespread loan defaults across India? Could that create a dangerous feedback loop with serious economic consequences? It's a powerful example of just how interconnected our global markets really are.
So, given all these complexities we've just talked about, let's step back and critically evaluate gold's protective qualities. Is it really a safe asset? Well, when you look at decades of data, a much more nuanced picture starts to emerge.
Just look at this. We all have this idea of gold being safe, but look at how dramatically its risk profile has changed over time. In the turbulent 70s, you could expect to lose over 6% in a single day in a worst-case scenario. Now, compare that to the relatively stable 90s, where the risk was less than half that. The key takeaway here is that gold's safety isn't some permanent feature. It completely depends on the economic and political world around it.
But here's where the data gets, well, really interesting. We always talk about gold protecting you from losses, but the research shows something pretty incredible. During the absolute worst market meltdowns, gold's potential for massive gains has actually been bigger than its potential for losses. This suggests that in moments of pure, unadulterated chaos, gold isn't just a shield. It actually becomes a tool for some pretty high-stakes speculation.
So, how do we sum all this up? What's the bottom line? Well, the researchers behind this analysis put it perfectly. They said gold is still an effective tool for diversifying a portfolio, mainly because it behaves so differently from stocks and bonds. But, and this is the important part, it should not be considered a standalone or guaranteed safe haven. Its protection is conditional and it is highly situational.
And this brings us all the way back to our big picture question. After looking at the history, the macroeconomics, the geopolitics, and the hard data on risk, what does gold's soaring price really tell us about the state of the world today?
So what is gold's soaring price ultimately telling us? Is it the rational choice in a world drowning in uncertainty? Or is it a vote of no confidence in our entire system, a warning that our collective faith in currencies and institutions is starting to crumble? You know, perhaps the most telling answer isn't that it's one or the other. It's that in today's economy, rational calculation and raw fear now look exactly the same.